If you could all come in and take your seats, that would be great. We are going to get started. Good morning, everybody, and welcome to the 2025 FTA CEO Summit, Fintech as a Catalyst for Innovation. My name is Peter Renton, and I will be your MC for today's session. And whether you are here in person or online watching us, thank you for joining us. So, Fintech innovation is having a real impact. As the 2025 State of Fintech survey demonstrated, and you see the QR code looping on the screen over here, I encourage you to download that, download the survey there. But as that survey said, the vast majority of consumers and small businesses say that Fintech is making their lives better. But we have so much more still to do. And yet we are in a unique moment right now because we have a new administration and a new Congress that wants to encourage financial innovation. And that is putting us in, I think, as an industry in the best position we've been in a long time. This morning, you're going to hear from both industry leaders and government leaders. These are the people at the leading edge of driving financial innovation forward. So without any further ado, please join me in welcoming the CEO and President of the Financial Technology Association, Penny Lee. Penny?
Thank you, Peter. Good morning, everybody. And welcome to the annual Financial Technology CEO Summit. It's great to see everyone here. I know it's an early morning and a hot morning at that, so appreciate everyone here this morning. You know, it's inspiring to see so many across the financial ecosystem here, founders, investors, policymakers, and advocates, all here with a stake in driving the future of finance. You know, here at FTA, we believe in something kind of simple but yet profound, and that is Fintech is a catalyst for financial innovation. It's not a vertical. It is the infrastructure driving how Americans earn, spend, invest, and build their future. As we all know, Fintech is powering faster, cheaper, and more inclusive financial service. It's transforming how small businesses access capital, how families manage their funds, and how workers get paid. So today, as you will all see, please take a moment. I don't know if we have the QR code. Take a moment. We have a new survey, State of Survey Financial Survey, and there's a lot of great information that is there. 8 in 10 consumers, 9 in 10 small businesses use Fintech on a daily basis. Flexible, faster payments and user-friendly design stand out as key difference makers. 79% of consumers and 95% of small businesses say Fintech better meets their needs. But as we know, innovation doesn't happen in a vacuum. It requires policy that keeps pace, markets that reward responsibility, and leadership that doesn't react to change, but shapes it. Over the next 2 hours, you will hear from some of the most influential voices at the intersection of technology, finance, and policy. Chairman French Hill is with us today, and he is going to share his perspective on modernizing our financial system and Congress's role in it. We'll hear from New York DFS Superintendent Adrian Harris on how the state regulators are also looking at approaching innovation and the accountability they expect from companies. And you'll hear directly from our members, from our CEOs, those founders and CEOs of Mercury, Betterment, Chime, Revolut, MX, and Remitly, on how they're scaling and solving real-world financial challenges. This is a moment to learn, to challenge assumptions, and to collaborate. We're proud today to bring you into this conversation. And thank you for being here, and thank you for our sponsors, to Banking Circle, Mercury, Chime, and Stripe, for making today possible. Without you, this would not happen. So with that, please let's make a round of applause. Let's get started, and welcome to the stage, Chairman French Hill.
Thank you very much. Good to see you.
Good morning.
Yep. Like the suit?
Yeah.
It's
You
hot
got,
as
the
hell
mem-
here.
you got the memo on seersucker.
I did. I did.
You've already had an early morning. You were on CNBC first thing this morning.
Yep.
I assume shaping markets before they opened. Anything to
Hope not. That's not my job.
Well, your words do matter. And you know, you took the gavel earlier this year, and with that taking over the gavel and over chairman of the House Financial Services Committee, you laid out an agenda to not only strengthen community banks, but also to think how we should modernize our financial system. And would love for you to kind of talk about your vision and where you want to see Congress help to shape, but also where we might be heading as a U.S.
You bet. Well, this is a shared view in the House Financial Services Committee. It goes back several years, including when Maxine Waters chaired the committee 5 years or so ago. But certainly with Patrick McHenry, our former chairman, and Kevin McCarthy, our former Speaker of the House, there was a real consensus that we want to make sure that we're on the, you don't want to be on the cutting edge, but we want to be on the leading edge of how to modernize the American banking system, because we're the largest capital market, the largest banking system, and the largest economy in the world. Those things go together, and so we want to be in that way. So Maxine, I credit her, because Maxine formed the first Fintech and AI task forces. I was the lead for the Republicans, and Steve Lynch and Bill Foster did that for the Democrats, and that goes back to the 2018 timeframe, recognizing this was going to be important. What are the foundations of a broad fintech modernization across the economy, and how do we work on it? Well, one, our supervisors inside the traditional banking system have to recognize that, both in sense of partnership and also adapting new players that want to seek licenses to do things. So you have to look at the existing system, both in capital markets at the SEC and CFTC, as well as in the banking supervisory system. Next, in my judgment, you've got to have a nationwide privacy standard that, I'll use the famous word that makes people grumpy, but that preempts state law on privacy, so that we have a universal privacy standard in the country. We've done that. It's very painful. You know, this is a top priority for you, but it's a painful thing. We did it in food labeling, you know, and the holdout was Vermont, you know. Why is that? But Vermont's was the holdout, but it got done. So it takes work. So nationwide privacy standard, I think, is important. And then really robust multi-party authentication, cyber protection. Because if you want to go fully digital, fully peer-to-peer, blockchain or not, you need those robust foundational standards before you can build up from there. And when we see foot faults, in my view, you see them due to people not following in one of those key areas. And then I'll just conclude by saying we definitely want to see a market structure framework and the rules of the road in and around using blockchain in financial services as a fintech. And I guess I will add one more thing, which is we are aware of, and we did an extensive amount of work in the last Congress on how AI will impact financial services and fintech, both behind the house, in the back of the house, and in the front of the house, serving clients and customers.
And you mentioned it there just briefly, but one of the topics that is very ripe right now on Capitol Hill is stablecoins, market structure. I would say you're trying to clarify a stable genius, if you add all three together. Yeah. Talk about the importance, and it's coming out of the Senate. Senate is obviously taking the genius bill. You have stable in the House with the market structure, clarify. Talk about maybe some of the differences, and where do you see the House adopting? What are some of the issues that still need to be worked through in the House?
Yeah. Well, first, let's step back and say, what's the big picture? Joe Biden, in an executive order, identified the regulatory market gaps in the digital space for blockchain. So what's a commodity? What's a security? How do you regulate the spot market for Bitcoin, for example? How do you have a dollar-backed stable coin that could be a new payment rail on a blockchain? That was identified by Biden in an executive order, and we worked in the 118th Congress under Patrick McHenry's leadership to adapt each of those, find solutions to each of those comments. And we did, and we got strong bipartisan votes in the last Congress. We've built on that in this Congress, and President Trump has done exactly the same thing. He's ordered his agencies to look at what they can do without legislation to spur a blockchain use in the economy and blockchain-based tokenized payments in the economy. But he's also told the legislative branch, we need a law about a dollar-backed stablecoin, and we need a market framework. And then in President Trump's case, to be different from President Biden, President Trump does not support a central bank digital currency. And so and has issued an executive order to that effect. And we have a bill led by Tom Emmer, our majority whip, that would say there can be no central bank digital currency without a specific authorization by Congress. So those are the elements. We want to get all three done. President Trump's asked us to get all those passed. So what we're doing is, what is the best strategy to achieve that? On differences, they're not substantial differences, but they are differences in the Stable Act in the House under Brian Stile from Wisconsin versus Bill Hagerty's Genius Act in the Senate. State pathway is a little different. There's a cap in the Senate bill that says once you hit $10 billion in stablecoin issuance, you go federal on oversight. They have a different federal overseer. They have the Fed. We have the OCC in the House bill. How is banking and commerce treated? This is an age-old issue in finance and so the Senate bill has a provision where they block public big tech companies from issuing a stable coin. I don't know what the definition of big tech is.
I'm curious, yeah.
Well, I mean, this, when you write laws, you have to, the most important thing when you read a draft bill is the definition section. Yeah. Like, where'd this come from? So that's a difference. We don't have that provision in the House bill. Both bills have robust extraterritoriality features, which I think are very, very important. Would you let anybody from another jurisdiction outside the U.S. Who has a broker-dealer come into the U.S. and just start offering securities and doing business with customers without registering in the United States? Would you? No, of course not. And the same is true in commercial banking. So there's strict reciprocity standards in both bills. I think that's important on how to handle non-U.S. potential stablecoin issuers. But these are all things that we can reconcile. Bill Hagerty and Brian Stile and those teams can do that effectively. So I'm looking forward to that pathway, and I'm looking forward to also, though, the market structure work proceeding. We have the Clarity Act, which G.T. Thompson, the chairman of the Ag Committee, and I introduced in the House. And just yesterday, Tim Scott, the chairman of the Senate Banking Committee, and Cynthia Lummis, the chair of the Fintech Digital Subcommittee over in the Senate, issued their market structure principles. And that's very important. It shows momentum in the Senate because you can't have a stablecoin bill and declare victory. You need both bills to meet the president's executive order, and you need both bills for the private sector to fully innovate and be able to take advantage of a blockchain financial services future.
And one of the things on that is oftentimes we see in Congress that if, they'll declare victory on one thing, but you're saying that both have to be paired. And the fear is if you just get stable genius done, everyone's going to stop for a little while, and it is important to pair those two.
Well, I'm not arguing in front of this audience that they have to be paired, quote unquote. I'm flexible in the legislative strategy, but they have to both get done in a common time frame. And both have long tails to write rules and bring them up to speed. So it doesn't per se have to be simultaneous, but you can't pass one and declare victory and think like, we've checked that box for digital asset leadership in the United States. If you want a, quote, golden age, close quote, you need to have both these measures gotten through Congress and have these regulators cranking out the work we're asking them to do, which will be significant.
And it's to be commendable to take on this, innovation space with digital payments or digital assets and kind of how this future of finance looks. But as you and I both know, most of America, maybe 90+%, still work and live in a digital world. My AC repairman yesterday asked me for a check for payment. And so there's still
hope you didn't deposit it in a blue mailbox.
Yeah, exactly. So there's still some analog systems, some legacy systems in place. And one of the things that we have advocated for and want to work with this committee on, and curious your views on, this payment modernization, those that are in the dollar-based section. How do we make the U.S. system, as it relates to payments, dollar-based payments, more efficient, more effective, more faster in that respect?
Well, I do think that a payment rail, experimenting in a payment rail by a high-quality, well-financed company using blockchain has the potential to offer a different approach that would be better auditing, faster, 7-day-a-week settlement, and good, both peer-to-peer and in a POS, point-of-sale type environment. But I'm not saying it's imminent, but I think that will provide a new look. I think it will make the entire payment system more competitive. So that's point one. Point two is where we have an analog, approach left, and I remind people all the time, they think they've done something quite digital when they Venmo somebody. It's quite not digital. And so we still have analog systems that that knit our payment system together. And I think we should be spending just as much time in infrastructure going, truly real-time, not analog system based, which means you can certainly do that without a blockchain. So I think it will make the payment system more efficient, broader, more competitive, and for people concerned about the agency costs inside the payment system, that'll make it more competitive, and that spread will shrink, in my opinion.
And on that, is this something that the committee would consider? Perhaps we've seen in the past some, optional fintech payment charters. Is this something that the committee is looking at, hearings around just how we go about this?
We definitely want to have the views from our supervisory agencies in finance, take their views. We want to take the views of the state, the state commissioners, like our great commissioner in New York you have speaking today, get their views on how this would work. I think that's important to have a state-federal viewpoint on that. So that's true. And also this idea that Nellie Lang, President Biden's Undersecretary at Treasury, who's now at Brookings, Nellie gave a speech like 3 weeks before the election last fall. I'm not sure about that, but it was an interesting, good speech about what might be the role of a national payments license. And I think that's something you'll see the committee and the regulatory system explore that as well.
Shifting gear just slightly, underpinning all of this innovation that we see here in the U.S. and globally as well is this notion of open banking and the ability for consumers to have control of their data and to be able to share it to fintechs, third-party apps, services and platforms in which they feel that they could live their better financial life. Yep. Administration has indicated in court that they would like to vacate and possibly rewrite this rule. Curious from your perspective how either Congress or in the statutory or in the regulatory body too ensure that this capacity and this ability for consumers to permission remains and that it isn't thrown to ambiguity, but this innovation is allowed to thrive based on that notion.
Well, first we have, for the first time in years, we have a joint effort between the House Energy and Commerce Committee and the House Financial Services Committee to really address this federal privacy standard that I'm talking about. This would be the extension of Graham Leach Bliley, modernizing GLB. And that this is a place where you could touch on that because it would touch about, that individual's right to privacy, that individual's control of data. So one place I think you could see that addressed is in the draft legislation that those two committees are working. Secondly, when it comes to the rulemakings, yes, I think a lot of that should be done by regulation, but I think it should be driven by the standard setters out in the private sector, like the data exchange work that the fintech firms have been involved in. I go back to, in my 20s, I formed a payment company in Houston, Texas, Pulse, which became the Southwest's largest ATM and point of sale service. It's now part of Discover, Cap One, I guess. But at that time, it was who set the standards in credit and debit? It was the banks. The banks set those standards, and then the federal government, you would say, adopted them. So I think the private sector engaging on standard setting is absolutely the way to go. I've never been, and we used to badger Patrick McHenry about this all the time, as a former banker, financial person, analytic person, no offense to groundbreaking, successful fintech companies, so don't take this personally, don't look down at the ground and frown. I've never been for screen scraping. I think it's a terrible practice, but I also know that a lot of businesses, including businesses in this room, could have never started without that concept. So I got it, but APIs, you can't have the foundational feature I described a few minutes ago, cyber protection, multi-factor authentication, privacy, and the right to your own data if you don't have super secure features of accessing that data and using it. And that's why I've never been a fan of screen scraping, and that I prefer, in the old days, you could have gone and gotten an API, but if you talk to certain pioneering fintech companies, they tried and were rebuffed by, corporate brand X. So then they took corporate brand X's copyrighted material and used it anyway. That's a whole nother story. But you get my point. I think this is a key area our committee should work on. This is like the next step that I hope that Brian Stile and his committee on fintech, AI, and digital work on. And you guys will be a major part in that. But I'd love to see those standards driven by, the private sector.
We have just a little bit time left. Shifting to your chairmanship, you were on the committee for a long while, but now you have the gavel. What is something that has been surprising to you since you've taken over the gavel?
I've gone from about 6 hours sleep to 3. So, like when Trump tweets, I'm seeing it in real time. It's...
And do you jump every time, or do you just...
I really don't. I usually roll over and laugh, yeah. I think our staff is incredibly talented, incredibly hardworking. Ben Johnson, our staff director, and Allison Buniak, our policy director, and their team are outstanding. Our doors are always open to you and your ideas. And when you have the House and the Senate and the White House in the same political party, and you've heard this your whole career, you have an opportunity to get a lot of things done if you get it in sequence. And depending on what party you're in, sometimes those are for good, sometimes those are for ill. But when it comes to banking, Tim Scott and I are committed that we're going to make changes for our community banks on tailoring regulations. We've made a commitment that our capital markets will be more competitive and lower cost if you want to either do crowdfunding or go public, that we want to have remove barriers to housing affordability where we can and make HUD accountable. It's not a particularly accountable government agency. We want to increase that accountability. It's a real priority for Senator Scott. And we want to have fintech and crypto digital assets rules of the road. And these are big goals, but they're shared by the House, the Senate, and the Trump administration. So we're excited about the opportunity.
Mr. Chairman, thank you for your day today.
Thank you all.
Your time today. Thank you.
Kenny, appreciate it.
Okay, thank you very much for that. So we are moving on now to our first Fintech CEO interview of the day. And if you're sitting at the back or sitting around the sides, there are plenty of seats down the front, or you can feel free to take a seat if you want. But anyway, we We're going to move now to business banking. And Mercury has become really one of the industry leaders here in a fairly short amount of time. And we're going to explore today how they've been able to do this, how they've been able to do this responsibly. And I think they have just a fascinating story. Small business and startups, it's the growth driver of this economy. So please join me in welcoming Ahmad Akund, CEO of Mercury. To interview him, we have Tim Myopoulos. He is the former CEO of Fannie Mae, the former CEO of Silicon Valley Bridge Bank, and a Mercury board member. Gentlemen.
Hello, everyone. It's nice to see you all. It's great to be here. As was mentioned, I joined the Mercury board just a few months ago as part of the Series C. Joined Ahmad and his team, and couldn't be more excited about it. You know, from my experience at SVB and many years in the industry, obviously the traditional banking business has significantly underserved entrepreneurs and small to medium-sized businesses. And to me, that was one of the really exciting things about joining the Mercury board. So Ahmad, you've been a serial entrepreneur. You know better than, or at least as well as almost all the people in the room, just how hard it is to build something. What led you to decide to create Mercury, and what were you trying to solve?
Yeah, I've been an entrepreneur since 2006, so Mercury is my fourth company. I had this idea in 2013, actually, and at the time, I'd never done anything in fintech or banking. So it was more of I wish someone would solve this problem rather than I will solve the problem. And my frustration was, you know, as a small business owner, I just didn't feel like banks liked me. You know, there was lots of fees. It was very hard to do anything. You know, the rest of the stack that I used as an entrepreneur had improved. So, you know, when I started, there was no Stripe, there was no Gusto. It was very hard to do anything as an entrepreneur. But by 2013, you know, a lot of these tools had modernized, they'd become really good. But banking was the same old companies and not really innovating and not really catching up with the digital age. So I thought someone should fix this. And then in 2017, I sold my previous company. No one had fixed it yet. So we started. And initially, it was really providing an operational bank account to entrepreneurs. I really wanted to help people like myself who were starting businesses to easily get up and running and be able to do payroll, receive investment, make payments, et cetera. And then we launched in April 2019, and it's gone well since then.
Sure has. So tell us a little bit more about the customers that Mercury has. Like, who are you focused on serving?
Yeah, so today we have about 200,000 customers, and I kind of put them in the grouping of small businesses that are mostly digital. So yeah, nowadays, most people who start businesses are doing it in front of a computer. They're doing e-commerce businesses, startups, professional services. Those are our three biggest categories. But we serve small businesses across the whole of the US. And we don't just give bank accounts nowadays. We also have corporate credit cards, spend management, bill pay, invoicing. So if you imagine a bank account as this kind of core nucleus where that's where your money lives, that's where every business needs a bank account. But you have to do a lot with your finances, and it doesn't make sense to go sign up for 20 different services just to receive a payment from your customer or make a payment to your vendor. So we want to consolidate that and make it super easy as part of the software we provide.
It is pretty remarkable that no one's ever brought all those different aspects of the financial means of running a business together in one place. Like, what led you to think about that, and like, what do you think the key to that solution is?
I think, firstly, there's two parts. Number one, banks have historically outsourced software, right? So there's a bunch of service providers, do bank calls, and those people also build a mobile app and build a website. So they don't think of themselves as a software-first company. I've been a software entrepreneur my whole life, almost. Not when I was 18, but after that. And to me, it just makes sense to go, hey, this is where your money is. Why not actually make it easy for people to run businesses? So that, I think that's a big part of it. The second part is, for various reasons, I think banks don't think about their customer enough. we really go, what do our customers really want? And most of the things we build are not, I guess some of them are because I want it, but most of them are because we talk to customers and they're like, hey, I would love to be able to do this with my Mercury account, or like, why is this so hard? And then we're like, okay, let's just go build something that serves these customers. So, it's funny, Mercury is like half engineering, product design, and the other half is kind of compliance risk. Those are the two things that we kind of marry together to make Mercury work.
So the company has grown dramatically over the last few years, 200,000 customers. You're obviously touching something that's extremely important to every one of these entrepreneurs, which is the financial health of their business. How do you think about promoting responsible growth, like growing quickly, but also growing responsibly?
Yeah, good question. When I first started in 2017, I just sold my company. I was supposed to take a 1-year sabbatical, but I had this kind of itch to go explore this idea. And initially, we didn't write any code. We didn't really talk to any customers. I spent the first 7 months basically trying to understand kind of compliance, risk, laws. I wanted to, how would you even go about doing this in a legal and compliant way? Because, at the end of the day, what we do is very important to people. We're dealing with their money. And I think, the regulations and regulators exist to make sure that people do that in a responsible way. So I spoke to actually like 90 plus people, lawyers, regulators, compliance folks, et cetera. But obviously initially we launched when there was only 9 people working at Mercury. And in many ways we outsourced a lot of the compliance and risk to, at that point we were working with bank partners and banking as a service providers. Since we've scaled quite a bit, and now we have 1,000 people that work at Mercury, we realized that we were next to the customer, right? So it was, we could understand a transaction as it was happening, and it was our obligation to, screen it for sanctions, screen it for AML, et cetera. So we've really invested a lot in building that compliance and risk team internally. So compliance by itself is about 70 people at Mercury now out of our 1,000. And then operations as a whole is another kind of 150 or so. And really think of ourselves as kind of the first line that deals with customers, make sure we understand them fully. And then obviously we work really closely with our bank partners. And at this stage we have 4 bank partners that we have direct relationships with. And we have to make sure that we comply with what they're saying and what their regulators are saying, but also that they fully understand who our customers are, what every transaction is. And you can imagine we're kind of audited all the time by all these folks. So it has, as we've scaled, and we've scaled really fast, right? We've hit 200,000 customers, and we launched in 2019. So that's basically 6 years. And last year we did 156 billion in kind of transaction volume. So obviously the obligation that we have today is very different from when we launched. And we think very closely about working closely with our bank partners to make sure that as we scale, we do it in a compliant way. But we also, we have to not only do it for our scale today, we have to kind of now look forward 2 years from now. And if we keep growing, instead of 200,000, we'll have 400,000 customers in 2 years. And that means we have to keep upgrading what we do and make it scalable and make it work at scale.
So I think a lot of people would think, including people inside of banks, would think that all that compliance work would get done by the bank, right? And what you're saying is that Mercury's had to invest a lot in being that first line of defense on the compliance issues, even though the bank is ultimately responsible for ensuring compliance from a regulatory perspective. Like, how do you think about what Mercury is responsible for, and then what are your bank partners responsible for?
Yeah, great question. I actually think we have to be extra responsible because we have these 4 banks that we work with. We also introducing broker-dealer and RIA. So we have this responsibility across everyone. So we actually have to at the same time, we have to deliver a great customer experience. And to deliver a great fintech customer experience it's not just about like, here's a great app. It has to be, how does the compliance work? So a lot of people come to Mercury and say, wow, that was an amazing onboarding process. But actually, we have a really complicated onboarding process, right? Like a normal software startup is like, here's an email and a password, and you're done. Our onboarding process is like, give us your whole life and every single thing about you. But we've tried to streamline that. But in order to do that, we have to really go very deep and go, okay, how do we make this KYC process really smooth? How do we make it so as you're filling in the form, we understand, okay, this is a customer in this industry, and that's a higher risk industry, so we should ask another 5 questions, and we make it dynamic, et cetera. And we have to kind of homogenize all of these requirements across all of our partners and then present it to them. And when we present it to them, they're presenting it to their regulators. I would say we have to go an extra mile to make sure that all of these steps, whether it's onboarding, KYC, AML, sanctions, transaction monitoring, et cetera, are really we're trying to go above and beyond so that we pass all the requirements. And frankly, we see these things in real time, right? We don't want to wait until the bank partner sees a transaction and comes back to us and says, hey, what was happening here? We want to ask the customer right when they submit the transaction to say, okay, this seems like a potentially higher risk transaction. Can you provide an invoice or whatever it is that gives us more confidence that this won't be an issue for our bank partners? So we really try to be way ahead. And that means understanding, what they are assessing each transaction for so that we can assess it first, and doing that across 5 different partners.
And so you're the interface with the consumer, with the customer, not the consumer, but the business. You're interfacing also with a bank partner. You're not directly regulated by the banking regulators, but obviously they have a strong interest in what Mercury is doing and what the bank partners are doing. How do you navigate that regulatory landscape, and what's your relationship to the regulatory community, and what would you like it to be?
Yeah, good question. We work really closely with our bank partners. Since 2022, we stopped working with banking as a service providers and went direct with our banks. And I think, one thing that we would love is to have even more communication with the regulators that the banks are talking to, because often the case is that the regulator will say, hey, what is this user doing on this transaction, or what's the process we have here? And then our bank partners have to ask us and say, okay, what happened in this situation, or what's the process for this? And then we have to it's kind of a game of telephones back and forth. I would love that to be a direct relationship, because we really do try to go above and beyond. And I think there's a lot of nuance to all of this stuff, right? I'm an engineer, and when I started Mercury, I was like, of course, we have all of these laws, and everyone's everything's black and white, right? It's either it's law or not law. Where, there's just I actually just sat through kind of how our ops people monitor an app for fraud. And there's so much holistic thinking you have to put into this kind of stuff, because it's not one fraud thing, which, I mean, sometimes it is just one fraud red flag, but it's actually a ton of different factors that you're okay, you make this decision based on these 7 factors, and maybe 2 of them are orange flags, but 7 together is enough that you make a decision. But you do this across all of compliance, risk, and fraud, and all of these areas. So I would love for there to be more closer dialogue beyond us talking to our partner banks and them talking to the regulators. And one thing to understand, and I think maybe it's not obvious to people who know in the industry, I do think this is all very new, right? When I started in 2017, there weren't that many neobanks in the US at all. And this whole idea of how do you go partner with a bank was a very new concept. Obviously, there was this kind of surge in fintech in 18, 19, 20, and 21. But it's still very new. From a regulatory perspective, fintechs have only just reached a scale where regulators need to go hey, how do we understand this? And bank partners and fintechs also are part of that kind of solution. So Mercury's been a founding member of CFES, which is kind of our attempt to set kind of public partnerships around standards for fintech. And I think things like that are going to be the path forward, because I think almost every fintech wants to be compliant. They want to work closely with regulators. At the end of the day, we're trying to solve customer problems, and we can only do that if we can work with bank partners and with regulators on board. So I think there's this kind of, actually everyone is aligned on like doing the right thing, and we just need to come up with good ways of talking to each other and having good standards around that.
I think that's exactly right. I mean, just as it's been difficult for the fintechs to navigate this, I think for the bank partners, it's also difficult, and also for the regulators. I spent a lot of time talking to banking regulators, and for them, this has been a novel and interesting set of challenges. But I applaud what Mercury's been doing in terms of like trying to set standards and promote that engagement with the regulators, because I think it's really quite important. And you can't really build a scalable business if you're not able to do that. So looking out 10 years, like what do you see as the future of fintech? What will it look like, and what problems will it have been able to solve that it hasn't solved so far?
Yeah, good question. I think the thing that gets entrepreneurs like me excited and VCs excited, and VCs have invested a lot in fintech in the last few years, is it's just obvious that there's a problem and the industry is huge, right? So I mean, banks make like $2 trillion in the US last year. So it's just insanely big industry, and it's obvious that kind of tech has happened, and these banks have not caught up with that. So if you think about a lot of fintechs that exist, they're solving problems that banks could have solved if they had kind of jumped on the train. And so obviously some banks are innovating and kind of getting innovative and understanding their software, and AI is like what customers are expecting. But that's still like, I was actually talking to a big bank CEO recently, and they're still thinking about bringing up bank branches. And I'm like, I don't know if bank branches should be your priority right now. Like, that's just, it seems obvious to me that's not the future, right? The future is digital experiences and like coming up with, meeting people at their home and serving them.
Right, your bank branch is in your pocket. Like.
Yeah, exactly. And I'm not saying bank branches don't have a space, but like that can't be your main strategy. So these trends are happening, and it's, we've seen a ton of innovation. I said at the start of the year that most of the IPOs that will happen in the next 2 years will be fintech IPOs, and obviously that's kind of playing out. But that's just like fintechs have reached a scale where they are $10 billion companies, and there's a bunch of us now that are in these private markets that want to be public, that want to kind of hit that scale. So in 10 years' time, I think we're part of these kind of early exponentials. So going back to that bank CEO, not that I want to pick on him too much, but he's not seeing fintechs in his numbers. He's just like, hey, we're doing our normal strategy, and like, fintech seems small. And fintechs are still small, right? Like, even with Mercury at 200,000 businesses, there's 20 million businesses in the US. So we're just getting started. So, but in 10 years' time, when you play out these exponentials, right? Like if you can grow from 0 to 200,000 businesses in 5 years, and you're still kind of growing fast, in 5 more years, we have ambitions to be 1 million+ businesses. So I think we're going to see most, not just banking, but most financial kind of services that people use, whether it's lending or insurance or banking, et cetera, in 10 years' time will be coming through fintechs. And there'll be some banks that also innovate, but it'll be mostly digital, it'll be mostly on your app. And then the last piece is, I do think AI is going to have an interesting kind of effect on this industry. What we're seeing right now, and I think everyone in fintech is seeing it, is in the back office side of things, fintechs have, in general, actually been always at the forefront of kind of machine learning. Obviously with fraud, it's always been a big part of using all the data to try to find bad actors. Now with AI, you can kind of accelerate that. So not only in fraud, but in compliance and sanctions, there's just a ton of manual work. And it's not just about saving money, obviously that'll be a part of it, but it's also about doing things really quickly, right? Like if you have a queue where you have 20 people that are manually kind of processing a queue, that's going to take a while. Whereas like with AI, you can instantly look at not just that transaction, but everything about that customer and their history, compare them to every other customer, and quickly flag things, either block them. We tend to treat things as like 3 things, right? Either you block, you let it continue, or you flag it for a human to check. But you can imagine that happening through every single process in the back office, and that's a huge, actually customer experience improvement. Like they don't have to kind of sit on transactions for longer. But it's also, I think, a huge kind of time saving for fintech companies. And at the end of the day, if we save money or we save costs, yeah, that gets passed on to customers. So there's a bunch of things there. And then lastly, on the customer-facing side of things, there's obviously still kind of a big industry of financial advisors. And I think businesses, entrepreneurs especially, are often lost when it comes to kind of what to do with money and finances. And there's so many things for them to do to be compliant with tax laws and state-by-state laws, et cetera. So there's a ton we can do around fintech and AI to enable like these great customer experience. So overall, I think the next 10 years will be even more exciting than the last 10 years.
I agree. Well, thanks for being here.
Yeah,
Enjoyed it.
thanks for having me.
Okay, thank you very much for that. We are now going back to the government for our next keynote session. Let's face it, we all know New York is the financial capital of the world, the most important city when it comes to our industry. And so we're really honored today to have the Chief Financial Regulator here of the New York Department of Financial Services. So please join me in welcoming Adrienne Harris, and to interview her we have Penny Lee again. Ladies.
Well, thank you for joining us, Superintendent. It seems hard to believe that 3 years ago you attended our inaugural, and now it's become our annual CEO Summit. So we appreciate you coming back and speaking to us today. But for the Washington office in particular, would love, I know a lot of people are familiar, but your remit. You are the superintendent, as Peter was saying, of the most important financial, well, we would say the most important financial market in the world. And you are the chief superintendent of the New York Department of Financial Services. Explain a little bit about your unique role in this ecosystem.
Yeah, absolutely. Well, thank you for having me. It's good to be here with all of you. Everybody keeps saying, like, are you glad to be back in Washington, even though it's so steamy? Like, the weather is the same in New York. It is equally disgusting in New York right now. So for those that don't know, DFS regulates about 3,200 financial institutions, including state-chartered banks and credit unions, about 15 GSIBs, 120 foreign banking institutions. We regulate insurance across life, P&C, and health insurance. We are really still, until some legislation gets passed down here, the only prudential regulators of cryptocurrency, state or federal, in the country. We regulate money transmitters, mortgage servicers, student loan servicers, pharmacy benefit managers. We just got authority to regulate BNPL. So it's about 3,200 institutions, as I mentioned, almost $10 trillion in assets represented in those institutions. So we are the financial regulator in the global financial capital of the world, and have the remit to prove it.
Yeah. And you've also, I noticed you were in London recently, and you work globally with your counterparts as well. What is that experience like?
Yeah, absolutely. Because we have the 120 foreign banking institutions, many of our insurance companies are multinational insurance companies, certainly our crypto regulated entities. We do spend quite a lot of time with international regulators. I spend a lot of time overseas. They're obviously often in New York. And a lot of that is really engagement, because New York is so far out in front in so many areas, especially around innovation. The non-bank sector is really sharing not just intelligence and thinking, but also how we can regulate the space together, how we can make sure our requirements are harmonized, how we can share information such that we can all have a view of the entirety of the risk of some of these cross-border institutions. And in order to do that, not just are we spending time with one another in meetings, but for instance, we just launched the Transatlantic Regulatory Exchange with the Bank of England, which is a secondment program of senior staff around payments technology and cryptocurrency and stablecoins. So we really do work quite a lot. And often what we hear from our foreign counterparts is they really think of New York as their counterpart, especially around innovative technologies.
And you have said in past interviews as well that you really have set the standard for other jurisdictions around the world, especially with bit license. They are looking at you, New York, to kind of lead them on that way.
Yeah, absolutely. And I think it's true here in Washington as well. So the bit license, when we think about licensing virtual currency companies in New York, there's two ways that folks can get licensed. One is through the bit license regime. The other is through our limited purpose trust charter. You have to have one of those two licenses in order to do any virtual currency business activity in New York. And then once you get that license, which is not an easy thing to do, you're subject to full scope examination and supervision, much like we do with our banking and insurance institutions. So regular exams, we've now issued 9 pieces of guidance to add some meat on the bones of the regulation. So guidance on stablecoins, guidance on customer service expectations, guidance on blockchain analytics, guidance on market manipulation. And that really helps, I think, the industry understand our expectations based in the foundation of the reg, but as the ecosystem evolves, what our regulatory expectations are for our regulated entities. And then, of course, where necessary, we bring enforcement actions, and I've brought the first enforcement actions against virtual currency companies in DFS, large and small. So we really work very hard to use the full suite of our regulatory tools, from having the rule as the foundation of our regulatory framework, to guidance, to the supervisory relationship with every one of our regulated entities has a point of contact on the supervisory team. And then where necessary, enforcement actions. And so what you hear when you listen to many of the congressional hearings on all the bills that have been moving through Congress over the past 3 years, or you talk to the authors of MiCA, or you talk to folks at MAS in Singapore, is really what they're working from is New York as the model.
And speaking of, we're obviously here in DC, and Stable and Genius and Clarity are all moving through market structure, plus trying to put some federal regulatory parameters around stablecoins in particular. I know you've been watching this. What has your input been? Have you engaged in it? How do you see these two bills, not only how they're shaping up to be, but how they would influence New York?
Yeah, absolutely. We've been deeply engaged, and I'm just very grateful to all of our federal partners. I don't think there's a bill, including the current ones, but going back now 3 years, where folks on the House side or the Senate side, Democrats or Republicans, aren't coming to DFS for feedback on bill drafts. And we're really grateful for that opportunity to engage, because we are quite eager to have a federal partner in the space. And so we do offer quite a bit of feedback on all the bills. I think primarily we focus on making sure a meaningful state pathway still exists. In our view, it would be a real shame if there wasn't a state licensing pathway, just like we have in banking with the dual regulatory system. We think that should be the case in the crypto universe, mainly because, gosh, what a shame it would be if you took the 10 years of expertise that New York had and the effectiveness of our regime, where we didn't license an FTX or a Voyager or a Celsius, where we managed, our companies came through the crypto winter very well because of our robust capitalization requirements. Why would you want to wipe out all that expertise and not leave a meaningful state pathway? So I think that's the crux of a lot of our feedback. We've, of course, weighed in on AML-BSA. Our regulated entities are subject to the same AML-BSA requirements as our banking institutions. Same is true with cybersecurity. We've spent quite a bit of time with Congress on offshore issuance, and of course the now famous or infamous provision 16D around uninsured depository institutions. So we've really spent quite a bit of time with our federal partners on this.
And where do you see kind of, if they do get it passed out of here in Congress, a massive proliferation of stablecoin use? Do you see a lot of people seeking more bit licenses, or how do you see the growth of this industry?
Yeah, I mean, our applications queue just continues to go up and to the right, and then we do see a lot of interest both on the bit license side, but also on the limited purpose trust side. And I would say, although most of our current licensees are bit licensees, we see more and more interest in the limited purpose trust framework, because it allows companies to engage in fiduciary activities. But I think the interest in this space just continues to go up. I think there's always this tension of over-regulating and under-regulating. You want enough regulation that there's transparency on what companies need to do and are required to do, but you want enough flexibility to allow for innovation. I think we've done that very well in New York, and my hope would be that the federal framework, when there is one, both on stables and crypto, follows suit.
Shifting gear just a little bit, there's been a change of administration, and with change of administration comes a host of changes as well, and some of that has been on the regulatory front, either pulling back staff or pulling back non-enforcements or just supervision or other things. As you sit back in your purview, kind of how do you see, or what is your engagement? Has it changed because of some of the changes in Washington, or how is it that you interact here?
Yeah. So for us, I get this question all the time, like, what's going to change in New York? How are you going to respond? What are you going to do differently? I think the answer often disappoints people because the answer is nothing. In my view, right, there is no place for ideology in financial regulation. There really should not be. And so for us in New York, we really pride ourselves on calling balls and strikes, right, for the baseball fans, for being data-based, for being evidence-based, and proving out the thesis that you can protect consumers and markets and be good for business, that these public policy objectives are not mutually exclusive. In fact, they're mutually reinforcing. In fact, we have an economic development mandate at DFS, much like the UK regulators now have their secondary mandate around competition. We have always had that at DFS, and so it really has been my mission to prove out that you can protect consumers and markets and be good for business. And so for us, the change in administration here, a change in ideology, the change in approach, doesn't really change the way we execute our mission. It doesn't change the way we engage with our federal partners. Now, it has been a nice recruiting opportunity, I'm not gonna lie, for DFS.
I would say I've seen in Union Station and Penn Station, please join us in New York.
Yeah. The governor has been very forward-leaning on recruiting. We've been very forward-leaning on recruiting. My new head of enforcement came from the CFPB. So we're not gonna lie, like that's a nice benefit for us in New York. We're still hiring. Just a little plug, we've hired or promoted over 1,100 people in my time at the agency. And we have, at any given time, over 200 slots available. So check out the website if you're thinking about being a financial regulator in the financial capital. But otherwise, when it comes to the substance of our work, again, we are evidence-based, we're fact-based. We want to prove this thesis that you can be good for consumers and markets and for business, and we work to do that every day.
And one of the things that you mentioned, New York legislature passed a provision recently on buy now, pay later, BNPL, putting some regulatory, or asking you to put some regulatory structure around this industry. How do you go about, and obviously we have members that are in this space, curious just how you go about rulemaking, or what is the process now that law has passed?
Yeah, so this was something that we had pushed for a few years, so we're very grateful that the governor put it in her budget and the legislature saw fit to pass it. As you all know, right, this is a space that's been growing so much. I think it's now 8% of e-commerce transactions are BNPL transactions. We saw $1 billion spent last Cyber Monday in BNPL transactions. So it really is a space that needs, again, those guardrails, still that flexibility for innovation, but those guardrails to make sure that everybody has a transparency around credit reporting, around disclosures, around fees. And so that's what we're going to do in our rulemaking. We really spend a lot of time on engagement. We're already talking with industry, with other regulators. The UK is working on their consultation paper on BNPL. So there'll be a lot of engagement before we even do a proposal. And then just like on the federal side, we have our own State Administrative Procedures Act requirements. They include a 10-day pre-proposal, and then the standard 30, 60, 90-day proposal period. We'll take back any comments we get and either repropose or finalize a rule. So we still have quite a ways in front of us, but engagement is really the crux of how we think about making a rule that can help us accomplish these various ends.
Yeah, because and appreciate that notion, because I think one of the things that's sometimes challenging is that they feel like there's this wall, like regulators on one side, industry on the other, and the two can't talk, and sometimes it might be a mismatch of kind of, again, to that point of balancing innovation, but also supervision and making sure there's rigor to it.
Yeah, and I think for us, for folks who know my history, my whole career has been back and forth between the private sector and the public sector, including in a venture-backed insurtech company. So I've been in the seat of entrepreneurs and having venture investors who maybe don't think compliance is necessarily where they want their money to go. And so I have seen that side of things, but also sat on public bank boards and many venture-backed private boards. So I think we do a really good job navigating this tension, bringing people into the tent. So we're making sure we're accomplishing a number of objectives all at the same time, making a rule that is fair and balanced, based in data and evidence, so that it can be a good rule for industry and for consumers.
Another top hot issue in these days in financial technology is AI. Generative, agentic, machine learning, like the full gamut of AI. This is obviously a technology that's borderless. Yeah. But how do you in New York think about approaching, because I think there's some laggard, it takes a little while in Congress to get stuff done, but how are you all forward leaning into kind of ensuring deep fakes are taken care of? Like, this is such an explosively new technology. How are you approaching this?
Yeah, so I think to your point, not only is it fast-moving, explosive, but we tend to talk about AI as sort of one thing. We might talk about generative or agentic. What we've really done is, instead of just thinking about how do you regulate AI, is really think about the use case and regulate it that way. So we've issued a couple of pieces of guidance so far, and there are more to come. The first one we did was on insurance underwriting and pricing and AI. We didn't even say insurance, right? We left for another day claims management, we left for another day customer service, and said, let's focus in this piece of guidance on underwriting and pricing. Talk about how the principles around prohibitions on unfair discrimination still persist, even with the use of AI for underwriting. Talk about our governance expectations, talk about our testing expectations, and we enumerated testing methodologies that we thought were fit to help for compliance in this space. So we really took a very narrow slice to help provide some guardrails for industry. Then similarly, we did a piece of guidance on AI and cybersecurity, and that was meant not to add new requirements to Part 500, which is the New York cybersecurity reg, but to say, here's how you should interpret Part 500 in the face of AI. And we talked about both how AI enhances threat vectors in cybersecurity, right? You don't have to be a nation state to perpetrate a large cybersecurity incident anymore because of AI, but also highlighted how AI can be used to enhance defense mechanisms for our regulated industries.
Yeah, I would say that's one of the things that we in the fintech industry have seen a lot is the use for fraud prevention. Being able to use it as a way to be able to help detect things that are happening. But it is going to take a holistic approach because, as you know, there's different fields that are coming in, whether it be from all different actor states, nation states, and others. And so, using it for, as you said, a tool for good. But there's also the negative side that needs to be brought in and reined in as well.
Absolutely.
As we close, would love just to, you've been in this role for several years now. Anything still left on the agenda that you're...
So many things. It's funny. Now I'm coming up on 4 years this summer. Sometimes it feels like 40. But we'll have more to say on crypto and stablecoins. We'll have more to say on AI. Particularly New York-y issue is we are up to our eyeballs in livery insurance in New York, thinking about insurance for taxi cabs and Ubers. So that's something that we're working on. So it's really never a dull moment. We've got a lot of things on the agenda.
Well, and I think one of the things that's so innovative about you and kind of how you've approached your office is you're willing to experiment on some of the apps. I know you've encouraged your staff as in the permissible factor that they're allowed, and to really learn. And I think it is so appreciative.
Yeah, I think it's really important, right? People forget, like, regulators are consumers as well. And so I want not only for us to bring our own consumer experience to bear, but it doesn't make sense to say, the staff can't own crypto, because we wouldn't say they can't have bank accounts, right? But we need to make sure the proper ethical guidelines are in place, but then we can bring sort of our regulatory minds together with our consumer minds to make sure we're being fair and balanced.
Yes.
Yeah.
Well, thank you for your time today and for making the trek down to DC. It's always great to see you and appreciate your time today.
Great, thanks for having me.
Okay, moving right along, we are going to bring up two fintech pioneers here. Both of these companies, the leaders of these companies that have been in the fintech space for over a decade. One, obviously, Chime just completed a successful IPO just earlier this month. Betterment's been a pioneer to helping Americans invest and save for a long time. This is going to be like a two-way conversation between the CEO of Betterment, Sarah Levy, and Ryan King, the co-founder and CTO of Chime. Bring it on up.
All right, thank you. Hello, everybody. So Ryan, congratulations on your successful IPO. Extremely exciting times to be here with you. I am a non-founder myself, so I would love to start with a little bit of your story and take us back to 2012 when you co-founded the business. What was the problem you were solving? What brought you to FinTech? Because I know that's not where you started.
Thanks, Sarah. Yeah, it's been a really exciting month for us at Chime. We had a really successful IPO earlier this month, which is a really important step on our journey and a really exciting one for me as a founder. Something I didn't ever really dream of achieving, and I imagine once in a lifetime for me, for sure. So yeah, we started Chime about 12 years ago. As you said, I didn't know anything about payments or banking or fintech at the time.
I'm not sure I said you didn't know anything.
Oh, okay, well, well, if you had said that, it would have been accurate. I think I know a little bit more now after doing it for 12 years. And we really started with a really quite simple hypothesis, which was that the banking industry at large was pretty good at serving more wealthy individuals in the United States, consumers. But if you were an everyday person who makes less than $100,000 a year, which is 3/4 of America, you weren't particularly well served, and you didn't get a good experience, and you didn't have a good product. And the reason for that primarily comes from how big banks work and how they make money. And if you think about the traditional bank model, you collect deposits and you make money lending them out. That's kind of how banking works. And so what that means, something like 70% of revenue from big retail banks on the consumer side comes from net interest margin. That's the spread that is between what you pay in to acquire a deposit and what you make lending it out. And that model doesn't work for everyday Americans who live paycheck to paycheck. Largely about 2/3 of the country lives paycheck to paycheck, don't have very large balances. And so that business model doesn't work particularly well. And so we thought there's a better way. Let's create a payments-based business model where we have an aligned incentive with our customers, our members, to help them. And so, Chime is now today, we have 8.5 million people who use us every month. We offer free checking, savings, credit cards, debit cards, loans. We offer all the things that you would expect to get from a bank, except that we're a technology company in the same way that many of the folks on this stage, including you, Sarah, are. And so that is our mission, is to help everyday people and help them with their financial progress. So that's what we focus on. That's the segment we serve. And what inspired me to get into that is, as a technologist, I like to use technology to build things that help people in the real world. And as a child of Silicon Valley, that's sort of not the real world out there. And so I recognize that, and so that's what motivates me to this day. And so Sarah, so I guess we're both asking each other questions here. Tell me, from what I've read, Betterment's been around for a while too, and I think you've been the CEO there for 5 years. Tell us about the company's mission, your role, and the folks that you serve.
Yeah, great. So I joined Betterment 5 years ago. I actually, just backing up, I spent the first 20 some odd years of my career in the media business, building great brands like SpongeBob and Yellowstone and Jersey Shore, depending whether you think those are great brands. And I was looking for sort of a next act at a business, and similarly didn't know anything about fintech, but was looking for a business that I could really believe in and a brand that I could build. And Betterment's mission just really resonated with me, which is making people's lives better. And how do we do that? We do that by expanding access to financial advice. And so when you think about historically only wealthy folks got access to financial advice because you needed, call it $1 million for an advisor to be interested in you. Similarly, we have a 401k product where we've expanded access to great retirement solutions, which has been very much enabled by a strong regulatory, backdrop, both federally and at the more local level. And so there too, we are expanding access. If you work for a big company, you have a 401k plan, and that's sort of a given. If you are one of the 50% of Americans that work for a small company, historically you did not have access to those sorts of retirement solutions. And it's really incredibly important as we think about Social Security for this next generation. Private investment and savings is just going to be critical to this next generation being successful, and you've got to start that early. And I really believe, and Betterment really believes, that we need to do that by empowering employers to be part of the solution on behalf of their employees. So that's what we do. We have about 1 million customers and $60 billion in assets under management.
Great.
Oh yeah, back and forth. Here we go. So okay, let's turn to, we're in DC, we're here with policymakers. Tell me about how Chime engages with lawmakers and why you think it's important for companies like ours, like Chime and like Betterment, to really participate in the dialogue with regulators as this next chapter emerges.
Yeah, you're about the 10th person today who's asked me, why are you here in DC? I think for us, and I imagine it's similar for many of the folks on this stage today, what we care about is making sure it's clear to policymakers and regulators what we stand for, and that Chime is a force of good in the world, especially for everyday working people, teachers, mechanics, folks like that. And that it's important for us to get that message through about who we're trying to help, and that we sort of fit well within the regulatory perimeter, and that we're not off sort of on the edges. And I think we care about as policies are being contemplated, especially in the areas of partner banking. You've heard several folks I think on the stage talk about that model and how it's led to lots of innovation in the space. We care about policies like stability and policies like interchange and things like that that help us deliver free or very low-cost financial services to everyday people. And so yeah, it's really just making sure we're on people's radar. We don't have a particular major upheaval that we need to make that we want to see in any laws. It's more like make sure there's stability and people understand the innovation that we're able to do under the sort of current rule set.
Let me go just a little
important for us.
Let me go a little bit. So one of the things I love about Chime, and I think that we share in common, we're both building brands. I love the brand work you guys have done. And we both have an incredible customer centricity. And I think that sounds trite because I think a lot of people say like, well, we're customer first. But I really do believe that both of our brands are very, very focused on doing what's right by the customer and really lifting them up. And our customer segments are slightly different. But I know that bank-fintech partnership is sort of an important aspect of delivering on that. So can you just talk a little more specifically about how that works for Chime and why that's important?
Yeah, great question, and I think it's important for many of the folks on this stage. But we offer banking products. These are FDIC insured, OCC regulated checking accounts, and I mentioned those types of products. And we do that in partnership with two small banks. One's called the Bancorp Bank, based in Delaware and South Dakota, and one is called Stride Bank. And these are nationally chartered, OCC regulated, FDIC insured institutions. The way to think about Chime is sort of the technology and consumer experience layer that sits on top. And that model is really important because it's enabled us to innovate, but in a way that stays inside that sort of regulatory perimeter that I mentioned. So we are very much not a move fast and break things type of company, as you might expect. One of our core values, ironically, is about the least Silicon Valley thing you could ever imagine seeing on the wall of a tech company is respect the rules. That's one of our core values of the company. And so, and that's because we sort of recognize the importance of doing right by our customers and all of our stakeholders. So I think that model of having direct relationships, you've heard probably terms like banking as a service and stuff, and there's some, we have a more direct relationship with our bank partners and our members together that really allows the best of innovation while doing so safely.
So let me go one more to you. Let me ask you just about your customer specifically. So who is the customer you serve? You sort of touched on that, but what is the state of that customer right now, and what are they concerned about? And talk to us a little bit about that.
Yeah, as I mentioned, our customers, we call them members, are generally people that make less than $100,000 a year. That just happens to be 3/4 of the population. So there's about 200 million Americans who fit that target, and so that's a wide, this is very broad demographic. A lot of folks live paycheck to paycheck, struggle with high fees from the banks that they're used to. Something like close to 90% of our customers are coming to us from broken relationships at existing banks that they're unhappy with. Some people say, oh, Chime, are you the bank for the unbanked? It's like, no, we're the tech, not a bank tech company for the unhappily banked. It's like a better way to put it.
That's kind of a mouthful. But
yeah, it's kind of a lot to say. But yeah, so 2/3 of our customers use us as their primary account. On average, people do over 50 transactions a month with Chime, so we're very much central to their life, and which means you asked about the state of our consumer and what we're seeing, and we can see that very clearly in our data. There's been a lot of noise about, of course, inflation and tariffs and the macro environment, but what we're seeing is the everyday person is actually very resilient and very stable. Something like 70% of our transaction volume and activity that happens on our accounts is for non-discretionary purchases. This is gas, groceries, bills, utilities, and so what we see there is a lot of stability in people still spending the same amounts on those everyday services. And then even for the discretionary, the 30%, restaurants, vacations, that sort of stuff, we see that actually very stable also. So we see no signs of a weakening, everyday person from a macroeconomic perspective, despite all the rumblings you might hear out there.
Excellent, excellent.
And then question back to you, sort of same question, on the investment side, what is Betterment? What are you seeing and how are you helping your clients and your customers navigate some of the volatility in the stock market and sort of what's going on in the macro environment?
So you say respect the rules, I say eat your vegetables is sort of my equivalent of that. And I think, our advice tends to be pretty boring, and I say that with sort of love and respect, right? Which is to say that right now, like when there is uncertainty, our best advice to our customers is stay the course, right? Is don't get distracted by the headlines, have a long-term horizon and a plan, and if you stick to your plan, the noise, the noise should not distract you. And when you think about like April, the tariffs on, the tariffs off, et cetera, if you looked at what the market did, those who panicked and pulled out of the market would have missed the rebound, right? And history would suggest that the average investor does not beat the market, does not know how to beat the market, sort of picking individual securities. So our advice has always been about global diversification, a long-term time horizon, a plan, and again, as I say, it's like eat your vegetables. And there are times in these markets where that's not that sexy, but I think sexy is not the goal, right? Long-term stability and retirement savings, that's the goal for us.
So no meme stock trading for
that
you guys.
Is
That's not your advice?
That is not our advice, no.
That makes sense. So another top issue that I think is affecting both of our populations of consumers right now is around the future of open banking. I know many of you in this room may be familiar with the 1033 rule, which affects what rights a consumer has to their own data. And can you discuss how that's important to you guys, if it is, and your customers and the broader ecosystem?
Yeah, so that, I would say that's probably the top issue for me when we're here today, is to think about open banking. And I would actually expand the aperture, because for my lens, I would rather call it open finance. But the idea, as you say, is about customers' rights to not only have access to their data, but then to permission that data. And I think the second half of that sentence is really important, because what we are hoping for is a standard set by the government that will allow innovation. And so what I like to tell a story of, if you sort of turn back the clock, imagine that you showed up at your financial advisor and you had a shoebox full of all of your account statements, and you sort of handed it to your advisor over the desk and said, help me, what do I do, right? This is really the modern equivalent of that. So we want to give customers advice, and we're going to be able to give them great advice if we have all the information, right? And so if they can connect their checking account information, connect an old 401k account, an old IRA, what might we discover through those connections? We might discover that an IRA is sitting in cash, but that the owner of that IRA thinks they're going to get investment-like returns. Well, let's help them with the advice to say, your time horizon is 30 years. Let's consider whether sitting in cash with no yield in this particular account is the best thing. Let's look at an old mutual fund sitting in a 401k that maybe has a high expense ratio. These kinds of advice elements, if you can't see the full picture for that customer, you can't give them the right advice. And to me, one of the great things that FinTech brings, and that certainly that we at Betterment bring, is this opportunity to expand access to those really basic principles that can set people up for success earlier in the financial journey. Because at the end of the day, it's not what you make in investing, it's what you keep, right? It's keeping your costs low, which we do through FinTech, and it's keeping your taxes low. And those are really the two goals that we're trying to espouse. And so open banking is really a path to that. And that's true, if I were to step back from Betterment and broaden it to the ecosystem, really this is about innovation. And it's about an opportunity really for companies like ours to push the big incumbents to basically drive better outcomes for their customers, whether that's through higher yields on savings accounts, whether that's lower costs. And that all can only happen if consumers can take their data and share their data in a safe and secure, standard way.
That's great. And we feel the same way at Chime. I think having the data be able to flow, we believe that the end customer owns the data. If you have data about your own finances, that should be yours and not belong to anyone else, and certainly not belong exclusively to somebody like Chime.
So let me close. We've got about a minute and a half. I will close, because how can we not talk about AI?
Yeah.
And you are the CTO, so talk about a little bit about the technology journey, but then bring us home with AI, because that feels like the topic du jour.
Yeah, it certainly is. It's a wild time to be alive, and it's a wild time to be in technology, especially with the rate of advancement of AI. And we have one of the advantages we have at Chime is we've sort of built our full technical stack top to bottom. We don't rely on third parties for banking cores and those sorts of things. We built it all ourselves. And so that really unlocks and unleashes, the best AI comes from the best data. And when you have full control over your technology stack and you have all the data, as you were just talking about, you can really do really cool things. And so one of the, we sort of, all of our employees in every function, not just in technology or product development functions, are being equipped with Iron Man suits, as it were, as we speak. That's going to be able to turbocharge the work they do.
That's super cool. I wish you'd worn that today.
Yeah, metaphorical Iron Man suits. But we're also looking at how AI can help give better advice and things like that to our members to help them with their financial progress. And in the few seconds we have left, maybe you can talk about how you guys view it at Betterment.
Yeah, I mean, I would echo what you said. I even think French Hill earlier kind of said there's the back of office and front of office, I think was his language on AI, and that's really how we're thinking about it. Back of office, it's supercharging us, and I love the Tony Stark, analogy. And then front of office, we're just starting to think about in a regulated world and with regulation, how do you introduce a little bit of AI into the advice layer in a narrow, controlled way? And that's kind of the next challenge ahead.
Great. Well, this is really fun getting to know you and chatting up here. So
Likewise.
appreciate it, and,
Thanks so
thanks
much.
for listening.
Okay, we are moving on now with a focus on open banking, but with a bit of a, we're going to do it a little bit differently. I know Sarah and Ryan there just touched on it. We're going to have a whole session now focused on open banking with another fintech pioneer, someone who has been in this space for over a decade. So please join me in welcoming up Ryan Caldwell, CEO and co-founder of MX. Ryan? All right. Welcome. Okay, so maybe just kick it off with a quick rundown of what MX does exactly.
Yeah, at MX, our main focus is taking data and being able to turn it into something valuable, turn it into action. And so first issue with data is connecting to it. And there's multiple types of ways connecting to it. You can connect directly to a bank's core. You can connect directly to a bank via aggregation or different methods like that. Once you have this data, it's usually not in a very usable form. So we've got to convert it into something that has been enriched, and then it has more handles on it to be able to do analytics and be able to run it through AI. Once you have that done, you can now get insights out of that data. But the bottom line is, if you don't get action out of that data, it doesn't mean anything.
Right. So there's been a lot of angst in the fintech space about the CFPB's movement to vacate the open banking rule. But it was interesting when we had our call a couple of weeks ago, you were talking about how this is really not the thing to focus on. You were talking about open source as being sort of the next iteration. Maybe you can explain what you mean there and how that applies to banking.
Yeah, I think it's interesting. There is this question around balance between regulation. Should we regulate it? Should we not? Treating it as if it's black or white or it's binary, and it's just not. Regulation at its best it needs to exist, but it's a light touch. And what you want is the private sector who knows, who's solving the problems, who's figuring it out. You want them to be able to deal with the complicated issues of the tech and then be able to create that framework that regulation can easily be able to ensure it doesn't get abused. Regulation has its place. It's very, very important, but you just can't be heavy-handed. It has to be a light touch. But if you don't have a great private sector innovation that's making clear how it should work, then regulation has to be heavy-handed because there's not structure that's already existing. One aspect of this that I think is really important to understand is I compare it to like the internet. If you look at, you want an open protocol, you don't want a bunch of proprietary protocols. We needed TCP/IP so that all of our routers and things could connect. But on both ends, you don't want proprietary servers either. You want something like Linux that can be open source, that gives you a great foundation that you don't have to repeat, invent, and reinvent. Just like in banking, there should be pieces on both sides that are open source that enable any bank or fintech to be able to leverage that and be able to communicate on these open protocols. Without that, regulation is really hard. With that, regulation becomes really easy.
Interesting. Okay, so then when in your conversations with banks, I mean, we saw the Bank Policy Institute, put their lawsuit out, and a lot of the top banks have been pretty critical about the way the Section 1033 rule was written. But I'm curious about what you're actually hearing from banks, particularly those smaller banks. What's the real story?
Yeah, so I think part of where you might have larger banks kick back, which is valid in a certain perspective. If they feel like they're being looted of their data in an irresponsible way that the user doesn't intend to have happen, they have every right to be frustrated. This is where if you have good standards, a good protocol, and this good open source solutions, you can ensure that it is truly data permissioned, that it is truly the privacy of that user's data is held, and it's permissioned on how they want it. But one thing that a lot of banks are starting to realize, and we're helping them understand this, is that to sit on the sidelines and to simply block the data is self-sabotage. Because you have billions and billions, tens of billions of dollars on a regular, near annual basis being invested in all of these fintechs. And they're coming up with these crazy solutions, 80% of which don't work. And you get to see these apps applied to your users. What users in your bank are connecting to which app? When do they stay connected? When do they not stay connected? Now, if you don't have really good user permission data connections, you're not sure did the user permission it, did the user intend it. But if you have the right protocol and the right exchange, the bank can see in real time what solutions that are out on the market work or don't work, and they can know exactly how they need to innovate. And no bank has a $10 billion R&D budget. But you have a giant ecosystem that's innovating, and you get to see how your users want to use it. When banks realize that, they're like, why in the world would I not allow access to my bank so that I could understand what my users want me to build? It's the best information that exists. Now that provides the world's best fintechs to thrive, as they should be able to, and the world's best banks to thrive. And one last point I'll make on this is people have asked me, so are you bank friendly or are you fintech friendly? And I've said 100% both. And they're like, well, then who's going to win? And I'm like, that's a misunderstanding of the space. The best banks that learn to become more and more like a fintech in serving their users in more powerful ways will survive. Those banks that don't do that will fail. The best fintechs that scale and scale will have to end up saying, well, I can still lend money, but I can't lend it with investment dollars. It's not efficient. I need to hold deposit dollars. Oh my gosh, now I'm regulated. Now I have this. All of a sudden, more and more, they start to look like a bank. And so there's going to be this new entity that will be the best successful fintechs and the best successful banks that will look like a bank merged with a fintech, and that's the future.
Right, we're already starting to see that, obviously.
We are seeing that, yeah.
Yeah. So when you say open source, I can imagine a lot of the bankers were thinking, well, hang on, open source, how is that going to be secure? How is that going to maintain privacy? How do you kind of respond to that criticism? Because the open source movement in fintech, like it's in tech, it's been around for a long time, but in fintech, it hasn't really become part of the culture, shall we say. So how do you address the privacy and security concerns?
Yeah, it's a great question. The truth is that open source is truly the only way to really know that it's secure. And we've known this for the longest time. Linux and other solutions like that, or like take SSL, the whole internet running on SSL, things like that, it's because everyone understands exactly what's in it. There's no hidden backdoors that can be exploited. There's no bugs and people are combing over it constantly at a worldwide scale to ensure it's safe. That is the best solutions that exist out there. And our entire, keep in mind, all of banking runs on top of the internet as it is right now. Mm-hmm. All of encryption and everything are all the standards that existed in this open sourced ecosystem. The best encryption is open sourced, right? So when you think about these types of things, for banking not to mimic that just doesn't make logical sense.
Right, okay. So then let's talk about the data itself. Like, I'm curious about how, one of the big criticisms of banks is, well, why should I give my data when I'm not really getting anything back for it?
Correct.
So what are some of the things that you can say that banks can get back? Do you have any examples of how this can work in practice?
Yeah, I think this is where there's this beautiful dance of innovation. And when people understand innovation is incredibly creative. But what people don't often like to admit about innovation is it's destructive as well. And so, and that's a good thing, not a bad thing, when it's done in a controlled way. So imagine a bank who already has all of the understandings of regulatory compliance and really taking good care of their users and looking out for protecting that user. They're born and bred in that. And then you have a fintech that's found this really innovative way to better serve them that the bank is blind to. And as the fintech starts to serve it, the bank can look at their users connecting, and the bank can now understand, you know what, that's not an area that I want to play. It's neat that they offered this robo-advising chatbot something. That's not what we do. It's cute. I'm glad we're enabling it. We have visibility to the fact that our users care about it, but we're not going to play there. Or they can say, hold on, that's core to our business. What are we doing? Why are we missing it? Oh my gosh, it's actually affecting our business. Because it's not just that they connected to this account. We saw that they're investing or they're spending or something shifted negatively over here. This is a fundamental thing that could kill our business, but instead of finding out 3 years, 4 years later, they're finding out the very days and the moments and the seconds that it's happening. That's the main argument to a bank of why would you want to be blind to that and enable it. And all that it means is if you sat on that information and did nothing with it.
Which is what happens now, right, for a lot of it.
But the best banks, though, are learning that they can act on this data. The best banks are realizing they can use it as a input for exactly what innovation they need to be driving towards. And it's very powerful.
So is that sort of some of the things you're doing? You're helping banks with their own data make intelligent decisions?
That is the core of what MX is. I mean, MX, and we help banks, because remember, I told you fintechs at scale are becoming more and more like banks. We help banks, fintechs, and non-banks alike figure out how to get out of this data the exact actions that they should be taking and their consumers should be taking that drive value for the bank and value for their consumer. And that's this gap, because the whole idea of just connecting the data and all these different little steps here, they extract little pieces of value, but how do you complete that full circle? That's what we need to help the banks do.
So is that part of the the kind of hesitation for banks? Is it because they don't really know how to use the data themselves, so why should they give it up? Is that kind of part of what you're seeing?
Yes, I actually think you hit it pretty dead on. Is that they're nervous that, again, the word that you hear every once in a while is looted. They're getting looted of data, and but to be candid, there's a reason why this frustrates them, because they've gone through these strict KYC, these strict AML. They have this huge regulatory burden that they've had to make their whole business focus around optimizing to that to make sure that they can exist in a highly regulated environment. The idea that someone just comes in and just loots all the data out of that, especially if they're like, do I really know for sure that was that person? Do I really know for sure that they permissioned it? Did they really intend for all of their account data to get sucked out? Or did they really just want that fintech to get a balance, right? And so that's the part where the banks are rightfully frustrated. That's where if we get better standards in how we communicate, it's like, no, we have full confirmation that user did intend to get the balance plus 30 days of transactions, or intended to get this. So if you have more discrete exchanges of data, it's better for the consumer, it's better for the fintech, and it's better. Now, anyone who wants to own the network in the middle in a proprietary, non-open sourced way, they're the only ones that wouldn't benefit in this scenario, but that's not good for the ecosystem. That's not good for the banks, it's not good for the fintechs, and it's not good for the consumers. So I'm fine having that one group not do well. But we want the banks to thrive. This country needs banks to thrive. We want the fintechs to thrive, and they can do it in a very synergistic way. And the entire main result of that is that the consumer benefits.
Right. So then what about those big banks that are just talking about, like a lot of them have said, we want to do this out. We want to go it alone. We don't want to be part of this whole kind of open banking movement. I mean, what's your vision for maybe for getting those people on board, or do you think it's like not as crucial to let those people do themselves and have the masses of banks that are not they're not big, that really have much more of an open mind? I mean, what's your vision to how this plays out, I guess?
Yeah, that's actually a really good question. I wasn't expecting you to ask that one, but that's a great question. What's interesting is we see this a lot with tech, where they're saying, well, we're going to build this. It's so important to us, we're going to build this one piece ourselves. That does work if that piece stays simple. It's not complex.
When does it ever stay simple?
And it's not constantly evolving. But as soon as it starts to evolve and evolve and evolve, if you don't have an entire ecosystem that can innovate that, that's why Linux just crushes it. Linux crushes it because every single time that the newest this or that comes out, newest encryption, newest any kind of communication protocol, newest kind of databases that we need to enter, that need to work with it, or whatever comes out, it's already being innovated at such a pace. What individual company could say, I'm not gonna use Linux, I'm just gonna create my own operating system and maintain it? And we're like, okay, well, there goes 50% of your budget, right? Are you really gonna do that? And by the way, that's 50% of your budget for wildly worse security, where the whole world isn't making sure it's secure and this and that. So this is why open source wins in these niche applications, that you're like, look, the whole world needs this kind of a Linux server for web serving or APIs or whatever you might need it for, and it just explodes. The whole world needs financial data needs to be communicated. They need to have a secure way to be able to connect to it. You need a secure way to be able to deliver it on both pieces. This should not be every bank reinventing the wheel. And I think what you're going to find is banks are going to realize, well, we're just going to do it ourselves. Then they build up a cost center to maintain code that almost overnight becomes outdated, and the open source pace will go so quickly that they'll say, how are we, this big giant bank, spending this fortune to maintain our own code, but yet we're always behind a bank 100th our size that's simply using this open source code? And so that's why open source ends up sucking in the gravity and the momentum.
So you're making it sound like it's inevitable.
It is
Open source is going to win. Well, what are the blocks? What are the things that are challenging then to have it win?
Well, you're always going to have people who will fight it. And often it comes from a degree of misunderstanding, to be candid. It's not that, a lot of times they're not even fighting it to their own benefit. It's that there is a belief that there's going to be some sort of benefit by having a proprietary solution or something like that. And every time that you see this, you'll see companies dump, I mean, you know, if you don't want to go back, it depends how techy you guys want to get. I don't want to use the Novell Network example, but you always have different players that are going to say, I mean, Microsoft Server could be an example as well. They're like, no, we want to control the server. We want everything to use Active Directory. We want it to be proprietary. We want it to be, and for a while they can have a little bit of success, but it's trying to hold the wave of a tsunami back. It's just not going to, it's still going to hit. So the smarter thing is to not to spend years and huge amounts of money investing in something that ends up going by the wayside. It's to get behind an open source project and help funnel it and immediately start benefiting from it and have your cost, even if you're a massive bank that thinks you can afford it, go wildly down while making everything more secure and stable.
So then what is the role for policymakers and regulators in this new open source system that you're describing?
Oh, that's a beautiful question. So, okay, so beautiful question. So just like FTX, so FTX is like a protocol. So we had MDX because we thought OFX was outdated and didn't work, and we needed it real time and better batching. So we created MDX, and then they asked us, hey, would you be willing to like let us leverage this protocol? And we're like, yeah, if it can become an open source standard, heck yeah, let it develop into FTX. We loved that idea. That's the language you speak. That's how we communicate. But then the mechanisms you use, your megaphone or whatever that you use to speak, the ways in which you initiate that communication and receive that communication, both sides of this open source are absolutely critical for the whole system to work. So, but yeah, I want to make sure I answered your question.
Well, what is the role for policymakers then in that system?
Yes, thank you. So I get so passionate about it. The role for policymakers is just like with FTX to say, let's not reinvent the wheel. We have the private sector of people who are very passionate and care about this that have already created FTX as a standard. Let's support that standard, right? And what they need to do is be brutal, in my opinion, on that standard of, is it open sourced? Are people trying to control it? Or are they trying to make sure that it gets collaborated? So you want a board, that's truly balanced across the industry that involves all the players so that everybody can innovate at a rapid pace. The idea that it has to go behind some closed doors to get super detailed regulation, heavy-handed regulation, is not ideal.
Right. So then how do you think about the timeline for realizing your vision? Is this like the next decade? How are you thinking about it?
It's happening right now. I mean, to be candid, some of the largest fintechs, some of the largest aggregators are all coming together, and this open source project is in full tilt. And there are people, I mean, some of the biggest names are leaning into it right now.
Okay, well, we'll have to leave it there, Ryan. That was fascinating. I applaud the work you're doing, and I think it's important. It's going to be fascinating to see how it unfolds.
Thank you, Peter.
Give him a hand, everybody.
Appreciate it.
Thanks. Thanks, appreciate it. Okay, you're stuck with me for a little bit longer here. We are now going to take a more global perspective. We have really been focused on the US domestically for most of the morning here. The next two sessions, we're going to open the aperture a little bit and talk about what's happening beyond our borders. Now, I think when it comes to consumer fintech or even small business fintech, there's few companies that are more global than Revolut. And I am delighted now to have the US CEO and the Chief Banking Officer for Revolut, Sid Jojodia, join us. Come on up, Sid.
Thanks, Peter.
All right. Okay, well, welcome, and let's just kick it off. I mean, I think most people know what Revolut does. You're a big name in this space, but maybe you could just give us a little bit of background about what does the US Revolut do as in comparison to sort of the rest of the world, particularly in UK and Europe.
Yeah, thanks, Peter. And thanks for having me. Glad to be here today. Why don't I start with talking about what Revolut is globally, and then I'll come back to the US to answer your question. I don't assume everybody knows Revolut. It's not yet a household name in the States, even though it's now a verb in many countries in Europe. We're not a household name in the US. So for those who don't know us, we are headquartered out of the UK. We're a 10-year-old, I wouldn't call us a startup anymore. I'd say we're a scale-up. We are present in 41 markets, have 60 million consumers and about 800,000 businesses who use our platform every day, and they use it for very different use cases. So we have domestic payments, cross-border payments, multi-currency wallet. We've launched credit. We have wealth management on a platform. In Europe, we have a crypto exchange. We're really designing the app to be a modern 21st century banking or financial super app globally. And the ambition is to be in 100 countries serving more than 100 million users daily. So that's the ambition with which we've started, and we're well on the way there. The US, by far, is the most important market outside of Europe. So while Europe, for us, we're really big and everybody knows us there, people still don't know us in the US. We just recently started a few years ago. So we're building our pathway in the US. Today in the US, you can do domestic payments. You can hold up to 30 currencies in your wallet simultaneously. It's the best product if you have any cross-border payment needs, both for a consumer or a small business. And we're about to launch credit over the next few months. So we continue to build out the product set. Today, we also have a robo-advisory product on the app, as well as a broker-dealer license, so you can trade equities on the app. We used to do crypto earlier. There was a lot of regulatory, I would say, lack of clarity over the last 4 or 5 years on what banks can or can't do in the crypto space. So we pulled that out. We do crypto globally, and we hope to re-enter crypto in the US as well.
Might be a good time to get back into it.
Yeah, the winds are definitely pointing in the right direction.
Yeah. So then, and I love the fact that you said super app, because so few US companies are really trying, it seems like, to do this. I mean, there's definitely fintechs are starting to broaden their offerings, but you're right front and center there, and particularly in Europe. How do you decide what to implement here? Because as you said, in Europe, it's a very broad suite. I mean, you're doing all kinds of things, not even necessarily directly related to finance in Europe. Is it the regulatory place, or the regulatory scheme here that sort of holds you back, or what? How do you decide what of all the products you do, what to bring here?
Yeah, great question. The licensing regimes obviously play a role, right? We do a lot of products in UK and Europe. Our ambition is to do all of those plus more in the US, so there's a lot more to come. Today I mentioned the things that we do, and I gave the example of crypto. We wanted to do it, we were doing it, we had to pull back out, and that's because of regulatory clarity and licensing regime. We also look at the end consumer and the end small business user. What are they looking for? What are the pain points? How can we solve them? And I'll give an example. A lot of our businesses use us for cross-border payments. They either have supply chains in other markets, or they have accounts receivables from other markets because they have clients in other markets. And this year in March, April, when there was so much noise from the administration around tariffs, we saw a big spike in businesses using us for Forex hedging because they were seeing a lot of currency risk. And if you're a business with low margins, a 10% move in currencies can wipe out your margins. So all of these businesses were using us to manage their currency risk by using hedging tools, futures tools that we make available to them. And that was powerful for them. So we keep working with our businesses and consumers to hear what is it that they use us for, what are their core pain points, and then we work to deliver products that solve for that. If you go back to our genesis, we started as a Forex player, right? So people in UK who travel to all of the other countries, our founder realized that there was a lot of leakage in terms of Forex fees or spreads from a foreign exchange standpoint. And so we built a better product, a way that you can save a lot of money when you're traveling in ways that would otherwise would not even visible to you, right? So we gave people that tool. And since then, we've continued to build adjacent products. So for example, in many markets, we've launched eSIMs. So you're flying to a new country, you land in the new country, you can immediately activate an eSIM through the Revolut app. And you immediately have data online, and your app works, everything's working. So you don't have to be dependent on your telco provider and buy an expensive sort of international plan when you're traveling. So we look at all the use cases, but from the sense of adjacency for how consumers are using our product or how businesses are using our product.
So do you think there's an appetite for super apps in the US?
Absolutely. At the end of the day, what do you and I care about, right? Who's making my life easier? Who is delivering value? Where can I get better value for something that I know I need to do? And the reason why financial services is as fragmented as it is, so I myself, I have a mortgage with a different provider than an auto loan with a different provider. And the reason is because not everybody does everything well, right? So it comes down to us earning the permission by doing multiple things well, right? And the super app concept, again, as I talked about, adjacency of product. So again, building on this travel theme of how initially users in the UK used us. So not only did we launch Forex and multi-Forex wallets, but we also launched the ability for them to book hotels directly on the app, right? So if you're in the UK app or the European version of the app, you go into the app, you're planning to go somewhere, you can do everything on the app. You can book your hotel, you get the eSIM, you got the Forex. It's a product that's meeting all of your needs. And that's the end ambition of a super app, is do all the things that you can to make the end user's life easier.
Right. You've got some of the biggest banks getting into travel here in a big way as well. So then let's talk about the tech stack. I mean, you guys are now a 10-year-old company. You really are putting out new products very quickly. How do you think about your tech stack? And you have worked in traditional banks. I think we can call Capital One a traditional bank. So how do you view that compared to what's going on in traditional banks?
So I think the thing with Revolut is we build everything ourselves. So we don't use off-the-shelf systems, and there's a couple of reasons for it. You can't innovate if you're using the same system as everyone else is using.
Right.
So you have to look at the pain points and build a system that works for you. The second is we're building a global tech stack. We're not building for one market, we're building for 100 markets. So how do you design a tech stack that's modular enough where you can build the core platform in a way that you get the efficiencies of scale? The same platform that serves 10 million consumers can serve 100 million consumers. It's just about scalability. And you get the benefit of bringing unit costs down by spreading the cost of that one tech stack across as many markets and as many end users as you can. And then the final element is last mile localization. So as you enter each market, what are the rules of that market? What's different on the onboarding funnel? What's different from a compliance and reg standpoint? So then you build that localization, but that's the last mile work that needs to be done. You don't build a tech stack for every single market that you enter.
Right, gotcha. That makes sense. So then you touched on it, the fact that Revolut began as this sort of international money movement app. In America, there's a lot of that sort of thing happening. Obviously, there's a lot of people sending money internationally here. What is your view of that market today?
So I think the U.S., I think it has over 30 million immigrants or expats living in the country. That's 10%. I was an immigrant at one point in time. So over 10% of the country is either an immigrant or an expat in the country, which means all of these people have lives outside of this country, whether it's a family that they're supporting over there, or they're here for 3 years and they have a mortgage back home or other assets and liabilities in all of those countries. So there is a need for cross-border payments. And when you go into business and trade, that's obviously core to what many businesses do, cross-border trade. So our cross-border payments infrastructure, I think, has historically, globally, been fairly poor. There are expenses associated with using all of the rails. I think there's a lot of opportunity to make it faster and cheaper. If I think about what Revolut does really well, there's 3 layers of how we think about cross-border payments, which is a Revolut customer sending money to another Revolut customer. Whether that's a business or a consumer, that transfer is costless, right? There's only a thin spread related to the Forex. And we try to keep it for most of the major currencies. It costs any consumer who's sending money to someone else in another currency, it costs less than 25 basis points in terms of spread. Whereas most banks will do it at 250 basis points or 300 basis points. I think G20 has a stated objective of bringing cross-border payments costs down to 200 basis points. For us, for most of our major currency corridors, it's less than 25 basis points. Now, so the next layer is you're a Revolut customer who's sending to someone who's not a Revolut customer, and it's a bank account or something else. Now there you do have to use the rails of the end user's bank on the other end. So there's a certain cost of that off-ramp that we need to sort of think about. And then the third piece is currency corridors that are exotic. There's capital controls. And I think that's where stablecoins can be very useful, is how do we use stablecoins to reduce the cost of at least the cross-border remittance, and then what you're left with is the on-ramp and off-ramp costs and the cost of sort of fraud management, AML, all of that on the two ends. But we're looking to bring all of those costs down as much as we can.
Right, right. So you are the chief banking officer for the global company, and you're here in the US. You've got an interesting perspective because you don't have a banking license here. You have banking licenses in many countries, I believe. I think you also recently got one in the UK, if I'm not mistaken. How do you view the sort of the bank fintech partnership? Because you obviously have to have a bank partner here, which you do. How are you viewing that versus getting your own banking charter?
Yeah, it's a great question. So first up, I think Revolut wants to be regulated directly. I know many fintech startups, at least in the beginning, don't want to be regulated, but we want to be regulated directly, and there's a couple of reasons for it. One is, if you don't have a seat at the table with the regulator, and there's an intermediary in between, then it impacts your speed of market, it impacts your ability to tell your story around how you're managing the business that you're managing and how you're managing risk and controls around it. And I think the challenge for us in the US for the last 4 or 5 years is there was no pathway to having a federal charter if you're a fintech, right? There were only 5 new banks that were formed in the last 4 years. Go back to 2007, 115 new banks were formed every year prior to 2008. Now the financial crisis and the rule changes after that fundamentally dampened things, but the last 4 years were really anemic in terms of new bank formation. So there's a need for, if you truly believe in competition, driving innovation, and really sort of moving the market forward across all of the vectors, whether it's payments, lending, you have to give a pathway to innovators to have direct regulation and an ability to have a seat at the table with the regulator. The other is consumer trust, right? If every time they read the T's and C's, they think they're engaging with Revolut, but it says the names of 3 other banks in the T's and C's, there's always confusion. Who am I dealing with? When there's a problem, who do I go to? You really build trust if you're the end bank on the other side of the transaction.
So it sounds like, you're not saying it directly, but it sounds like you are very much interested in the near term in getting a banking.
It is our ambition to be a bank in the US. So just today, we're a bank in the European Economic Area. So 29 markets in Europe, we operate as a bank. We're systemically important, directly regulated by the European Central Bank. We've been authorized as a bank in the UK. We've been authorized as a bank in Mexico. And we're looking to be a bank in at least a dozen other markets in the next couple of years. So you're going to see us continue to move forward as we build on this ambition of building a truly modern 21st century global bank.
So then what kind of support would you like to see from the regulators to really help you innovate and maintain your leadership role?
I think the critical 2 pillars would be clarity and stability, right? So clarity, what are the guardrails? What are the rules that we need to follow? The more ambiguity there is, the more chaotic the industry has to, the chaotic circumstances the industry have to deal with. So just with the Genius Act, the stablecoin work, I think more clarity now than the last 5 or 6 years. That helps the industry. Stability in the sense that rules shouldn't change every time there's an election, right? So if we're going to spend time building based on the new set of rules that are passed, those rules shouldn't change in 2 years or 4 years. It should be stable. So that would give us the ability to then build and innovate.
Yeah, let's hope we can get there. Okay, I want to talk about payments infrastructure, because you operate in a lot of countries where there's, like faster payments have been in the UK forever. You've got instant payments throughout Europe in a lot of places. What does the US need to do to catch up to these other developed countries?
Yeah, I think the US is far behind on payments infrastructure. I think it's a little bit of the landline versus mobile phone leap that other markets have seen, where markets that didn't have great landline infrastructure, they just went ahead and leapt straight to mobile phones. So while the US historically had great payments infrastructure, it's still using that same payments infrastructure, resulting in us falling far behind. We need to catch up. The other day I was at the grocery store. The lady in front of me was writing a check to pay for groceries. That's insane, right? I know there's a generational gap, but that's insane. We shouldn't be writing checks. We shouldn't be using cash for what are day-to-day transactions that can be done instantaneously, electronically, in every other part of the world, right? So I think whether you look at UPI in India or Pix in Brazil or Ideal in Netherlands, like every country is coming up with instant payment methods. US still doesn't have it. We have FedNow, but it's not adopted yet. Like no one's really rolled it out properly. You're not seeing customer adoption. There's a lot of work that needs to be done from a payments infrastructure standpoint. And I think it'll require rebuilding many pieces from the scratch. You can't, I think Chairman Hill earlier today talked about, you think you have a digital process when you're using Venmo. The rails on which Venmo is riding is still the legacy rails, right? And so we need to think right down to the brass tacks on how do we build infrastructure in a way that enables us to have instant payments, at the same time having the protection and the clarity and the data trails, the audit trails, for it to be a safe.
Right, because it's an illusion that the money is moving instantly in Venmo and lots of other apps. It's all an illusion.
But it's been done everywhere else, right?
Yes.
So, I mean, we just have to play catch up.
Yeah.
It's already been done in multiple markets.
Right. So then, in closing, maybe share Revolut's vision globally and specifically for this country.
I think, as we said, our bold ambition is to build a truly global 21st century modern bank. Everything you need to do, you can do on your phone. You don't need to have a brick and mortar presence. We aim to enable all aspects of your financial life. So today we talked about domestic payments, cross-border payments, unsecured consumer credit. We help businesses with a number of features. We're going to continue building on it. We've launched mortgages in Eastern Europe. We're going to expand that. We're about to launch business lending in France. We're going to build and expand into other markets. So we continue to add new product features. The end ambition that Nick, our founder, has stated is 100 markets, 100 million daily active users. It's a long way to go still, but there's a lot of work to be done. But we have the momentum. We're doing things right. Customers love our app, so we're going to keep working.
All right, well, I wouldn't be betting against Nick, that's for sure. He's a force of nature. Anyway, Sid, it was fantastic chatting with you. Thanks so much for joining us.
Thanks for the opportunity.
Okay.
Appreciate it.
See ya. Okay, we are now going to dive into a topic we touched on there, the international money movement. Now, this is a place that obviously people have been moving money internationally for, well, hundreds of years. But FinTech has come in and made this cheaper, faster, and most importantly, a much better user experience. One of the companies that is really at the leading edge here is Remitly. So please join me in welcoming Matt Oppenheimer, the CEO and founder of Remitly. Matt? Welcome.
Thanks.
Thank you. Okay. So maybe, why don't you just kick it off with the founding story, because I've heard you say this before, and I think it's a fascinating story about you've had a global perspective from your university days. So tell us a little about how Remitly started.
Yeah, absolutely. So I've lived and worked on 3 continents, traveled to close to 100 countries. But the most poignant component is when I was living in Nairobi, Kenya, and I was running mobile and internet banking initiatives for Barclays Bank Kenya. And for myself, I was getting paid in British pounds. I was living in Kenyan shillings. I eventually had to get money back to USD. It was, as I'm sure a lot of folks in this audience have experienced, whether it's studying abroad, whether it's sending money to a loved one, whether it's just having a connection to somebody internationally. It was expensive, it was inconvenient, and at the same time in Kenya, this was 14 years ago, M-Pesa was transforming domestic financial services. And so that domestic transformation of financial services combined with that pain point, I was like, there has to be a better way. And it's not only a business that was ripe for that, but it's a business that also makes a hugely positive impact on the planet.
So, but obviously there was already companies doing this, right? So what made you think that you could do this better?
Yeah. I think, if you go back 14 years ago, it's easy to lose sight, but at that point, there were some companies doing it. They'd taken more of like a desktop first approach, or even, obviously most of it was done in cash then. And about 30 to 40% of Americans 14 years ago had a smartphone. That's it. Isn't that wild? Like, it kind of feels like people have had smartphones.
Everyone has one.
Exactly, right? And so I saw that growth. I saw what was happening with M-Pesa. I saw how big of a problem it was. And it was one of those right solutions at the right time. And we've been fortunate to be able to make a big impact on the industry.
Okay, so people call these remittances. I know you were talking about international P2P payments. Mm-hmm. Maybe you can just sort of describe kind of how they work and who's using these products.
Yeah, absolutely. So Remitly's vision is to transform lives with trusted financial services that transcend borders. Most of what we do is international P2P payments. That could be sending money back to a loved one in Mexico or the Philippines or India, but it also could be somebody. I was talking to actually somebody in the audience today that said that they used a service similar to ours to be able to transfer money back to themselves when they were studying abroad in Italy. So it could be people studying abroad. It could be someone who's on a church mission and has a connection with folks that they established a relationship with. It could be somebody who, we offer transfers between the US and Europe, within Europe, somebody who's traveling or more of an expat. So there's lots of use cases. But what that all adds up to is the fact that $2 trillion in person-to-person payments are sent every year. $2 trillion. And we're proud of the fact that last year our customers sent $54 billion, which grew 30+% year on year. And we're now operating in 170 countries. But we're scratching the surface. It's a huge market, huge pain point. And our vision, going back to that, is around broad financial services, because we believe that if you look at the 250 million individuals and what we call micro businesses, very small businesses, that live and work outside the country they're born, financial systems are just not built for them. And that starts with payments, but then there's a broader set of financial services that we're adding to our customers over time to make sure that there is a global financial services platform for folks that have an international need.
Right. So I want to talk about the part of this bill that was passed in Congress where there was an excise tax on remittance payments. I imagine you're not for this, but maybe you could tell us your thoughts about it and how should policymakers be thinking about this?
Yeah. Well, if you look at the start of where that bill originated, it was about preventing illicit activity. And we can all agree we want to prevent illicit activity on our platform and in society and in our U.S. regulation. The challenge was how the bill was designed, because the way that the bill was designed would have been so broad that it would have it would have been not an effective way of accomplishing what the bill was intended to do. And so we're pleased with some of the revisions that came out of Senate Finance Committee that made it so it more narrowly focuses on the goal it's trying to accomplish. And the important thing by doing that is that we can both prevent illicit activity and we can continue to support innovation, especially in a digital world.
Okay, so then maybe you can talk about how Remitly is regulated specifically and talk about how you kind of prioritize secure international payments.
Yeah. Highly regulated. I came from banking before, and unlike some areas like crypto where there was maybe gray area of what the regulation looked like, we've always from the start knew that we were a highly regulated entity. Our second hire was our compliance officer. We're based in Seattle. Our compliance officer for the first 10 years used to run money transmission compliance for Amazon payments. So I give you that context because it's always been important to us from day one. Our business starts and ends with our customers when it comes to trust. We have to operate in a trusted ecosystem that includes banking partners, regulators, et cetera. The way that we're specifically regulated is we're a money services business, which means we have licenses in every state that requires it in the US context. We also are registered with FinCEN, and so we file things like suspicious activity reports with FinCEN. And then given that we operate in 170 countries, we also have licenses, as you can imagine, that are similar across the globe. And so because of that, we are under constant supervision, which we believe is part of building and maintaining trust with customers. And that supervision covers everything from safety and soundness to our AML BSA programs to making sure that our team has the right culture and expertise when it comes to money transmission compliance. And it's been a key part of our business since the day we founded it.
So then how do you specifically partner with law enforcement and regulators for that matter to stop this illicit activity?
Yeah, I think when we talk about illicit activity specifically in the US context, a lot of that is via doing things like filing suspicious activity reports, which then give law enforcement the ability to not only via Remitly, but across the industry, spot any bad patterns and make sure that we're, as a society, making sure that we're preventing illicit activity from taking place on legitimate financial services providers. And we're proud of the fact that we have scaled our systems in a way that does that, I think, pretty efficiently and pretty effectively.
Okay, so then, I'd like to talk about, secure payments. The US does lag behind much of the world, I think, when it comes to payments infrastructure. You're a member of the ASAP Coalition. It's a group working to modernize payments. Maybe you could talk a little bit about what that group does and what you would like to see from a policy perspective when it comes to payments modernization.
Yeah. So what that group's focused on is, if you think about our customer experience in the US context, we collect funds from customers either via a bank account, so bank account and routing number, or a debit card or credit card, okay? Debit cards are fast, but they tend to be more expensive. ACH is slower in the sense that you don't know the funds are good funds for 3 business days, and so you can't release those funds immediately. That ACH system and if you broaden it to an umbrella of bank-to-bank transfers in the US, is significantly outdated compared to the rest of the globe. And so whether you look at markets like India, because we have this global perspective, Brazil, or even Europe across the EU, the UK, they have implemented via sound good policy to give non-bank financial institutions that are highly regulated access to local payment rails. Some of those local payment rails are starting to emerge in the US, like FedNow. And so what ASAP is focused on is not just FedNow, but it's about modernizing our domestic payment rails, which would not only help with remittances, but would help a variety of merchants, e-commerce providers, to be able to collect funds more efficiently and more affordably from customers. And that is where we're focused on. That's what we're focused on with the ASAP Coalition. And we're excited about some real tangible progress that we're making in that space to make sure that the US, at the end of the day, keeps up with innovation across the globe, given that other countries have already done this. And so there are templates that we can follow, but we've got to do that to keep up.
So is that more just, embracing FedNow, RTP from the clearinghouse? Because we do have those things in place, they're just not used as much.
Yeah, so with FedNow, yes, it is partially focused on those areas, but with FedNow, non-bank financial institutions like remittance companies or international payments companies can't get access. Yeah. And so that is preventing some of the adoption that we've seen in other countries. And it's also why you see a lot of fintech, even some of the presenting companies today, a lot of fintech innovation happens in Europe or outside the US because the regulatory environment has, I think, been a little bit more forward-leaning there. So yes, things like FedNow exist, but non-bank financial institutions do not have access yet. So that's one priority. And then more broadly, to your point about RTP and your point about broader umbrella of just how do we increase the speed and affordability of faster payments, bank-to-bank payments in the US, is a key priority that I think the US will get there, but it's taking some leadership and education to be able to get to that point.
Right, well that brings to the hottest term of the month, stablecoins. I feel like there's endless chatter about it with the Circle IPO and the stable bill. How do you see stablecoin adoption? I mean, are you going to be an early adopter here? I mean, because it seems like some of the things you just said there, stablecoins can really solve the problem today.
Yeah, well, it's actually a great segue. So at a high level, incredibly excited about what's happening within the stablecoin space. And for context, I have been a little bit more of a skeptic of the broader crypto space in solving real customer problems. Stablecoins, I see the problems that it solves. I think that you think about some of the treasury applicability for a company like us in terms of being able to bring down foreign exchange costs using stablecoin as intermediary. I think that's an opportunity. And I think there is a desire for individuals to hold stablecoins, especially more stable currencies like USD, across the globe. Because take apart hyperinflation countries like Zimbabwe or Argentina. There's a lot of other countries that just have higher inflation and more volatile currencies than the US when it comes to foreign exchange. And so I think there's a desire to hold dollars across the globe. And I think there's real pain points that stablecoins do solve when the regulatory environment is clear. And so excited about the progress in the US context. But now going back to your FedNow or real-time payment systems, people forget what has to happen in order to get money into a stablecoin wallet is you've got to get it from fiat into that USDC account, let's call it. And in order to do that, there have to be fast domestic payment rails. And so I think that now that we've got clarity, or more clarity coming with things like the Genius Act, I think the next hill to climb is to make sure that there is faster and more affordable domestic payment rails, because I think that will help folks be able to speed up that innovation. And from our standpoint, what we're fundamentally good at is getting one currency to another currency. And so whether that's USDC wallet to USD, whether that's USD to you name your foreign currency, we have the infrastructure, the compliance, the fraud prevention, the money in, the money out to do that. And so when we see stablecoins being adopted in a certain country, as opposed to distributing into a bank account, into a mobile wallet, or to cash pickup, we can add stablecoins as part of that equation. And we haven't seen that adoption yet, but I'm optimistic about where that world's headed.
So yeah, you bring up a very good point, the speed domestically in getting it from USD to USDC, so we say.
Yeah.
So what about the back office piece? I mean, you know, moving the money once you've got it into, say, USDC, is that something that is going to be, you know, cheaper, faster, better for a company like Remitly?
I think where the back office piece opportunity for us is I think I've heard the term stablecoin sandwich, but I don't know if that's the exact applicability here. For us, it's about how do we leverage stablecoins, especially ones that are more broadly used and there's enough liquidity, to be able to get the best foreign exchange rates between one currency and another, using stablecoin as an intermediary between those. So that is, I think, where there's opportunities for us when it comes to infrastructure.
Right. So beyond stablecoins, what other technologies are you interested in, excited about when it comes to international payments?
Yeah. I mean, the other thing that everyone is talking about, but again, I think there's real customer problems, is AI. I mean, it is incredible, the level of innovation happening in AI. And we're leveraging that, whether it's giving our engineers tools to develop and deploy code more efficiently. We developed a virtual AI agent because while 95% of our transactions do not require any customer support, 5% do, whether it's a risk review, a disbursement, partner assistance. Our virtual AI agent is incredible when it comes to the overall customer satisfaction scores and the overall efficiency to deliver that service. I think there's really, relevant to this audience, I think there's really interesting applicability within AI to delineate from a compliance standpoint between good behavior and good customers that you want to let that transaction through immediately. 90+% of our transactions go through in less than an hour. But the reason it isn't 100% is because we've got to continue to invest in the latest technologies that can help us efficiently delineate between bad actors and good transactions. And I think AI, when you think about the ability, we already use a lot of machine learning for that, but lots of opportunities in AI to further improve our risk systems, both on the compliance and on the fraud prevention side. So I could keep going, but I will give you context again that I am somebody who oftentimes has been a skeptic about new technology because technology is only as good as the customer problem it solves. But AI is another one of those examples. So many problems are going to be solved within fintech leveraging AI.
Right. So let's talk about the Fed master accounts and access to the federal payment system for non-banks, because that's still, at this moment, is not possible. And I think we've, even with the if we get stablecoin legislation passed and signed here soon, it's going to be a while. So what, beyond the Stable Act, what should Congress prioritize do you think, when it comes to non-bank access to the Fed payment system?
I think that making sure that obviously you want entities that are highly regulated that have access to the to FedNow, but I think that making sure that those institutions, non-bank highly regulated financial institutions, have access to FedNow is, I think, key. And I think it's relatively obvious, but it's still work that needs to be done by this group, by Fintech Association overall, to make sure that legislators are aware of the low risk that comes with that and the very high benefit when it comes to adoption and ultimately customer benefit.
All right. Well, hopefully you can talk about that this afternoon in your visits to Capitol Hill. So let's take us through your vision for the future, and where do you think, particularly from in the international P2P payment space, what's your vision for the next 10 years?
Yeah. I mean, going back, first off, it's hard to imagine 10 years out. You look back 14 years ago, those stats around smartphone adoption, it's unbelievable, right? So I get really excited about 10 years out when I think about how much faster and more efficient not only our domestic payment rails will be, but our international payment rails. Again, we're at 90% are delivered in less than an hour, over 90%. There's no reason we can't get that up to 100%. Kind of like if you think about how when Amazon was started, the unreliability and the subscale component of getting a package delivered was there, but it took years and years to build out the infrastructure to be able to now order something and have the expectations that we all do now as e-commerce customers. I think that will exist with international payments, and we're going to blaze that trail both on a domestic and international basis. And then I think that when I look at our broad vision of financial services that transcend borders, I think there's hopefully not just us, because we won't solve every one of these problems, but I look out 10 years, and I think if you look at what it's like to move to a new country and the gap between credit access and credit worthiness, I think that will be bridged via a lot of data that we have that can bridge that in a more futuristic way. And then finally, it ties a little bit to stablecoin, but I think that we all live with a pretty monocurrency perspective, and I think that that will expand to multiple currencies that we're able to manage, not just for the top 1%, but I think there'll be technology and the ability for many, many billions of people across the globe to actually have access to financial services like holding multi-currencies that have historically been reserved just for a few very high net worth individuals. So I'm excited about the future, and our business starts and ends with trust, as I mentioned. So it needs to be done in the right way, with the right compliance, with the right security, with the right controls around things like AI. But I think with that, there's going to be some really exciting things that happen in this space over the next 10 years.
All right. Well, I'm excited as well. But anyway, Matt, thanks so much for joining us. That's all we have time for. Appreciate it.
Thanks, everybody.
Okay.
Thanks, Peter.
Okay, now I'm going to bring Penny back up to close down the event.
Just really quick, thank you all for staying today and for learning. I hope you learned a few things that were new. Appreciate you being part of the conversation today. As you can see, there's an incredible amount of innovation that is happening in this space. We want to be here to be able to help the U.S. move forward in this new kind of what we've envisioned the future of finance, with FinTech being that catalyst. So thank you all, and look forward to seeing you again. Appreciate it.